Wake up right now, because what the Trump administration just did with your tax dollars is not a political story. It is your financial future being decided without your permission. And if you sit there passively watching this, like it does not affect your wallet, you will spend the next decade wondering why your savings bought you nothing and your retirement looks like a bad joke. Japan tried this exact playbook. Not 5 years ago, not 10 years ago. Japan tried this in 1989, and the result was 35 years, not 35 months, 35 full years of a stock market that went absolutely nowhere. 35 years of workers watching their wages fall by 11% in real terms. 35 years of an economy shrinking on a per-person basis. That is the cost of getting this wrong. And right now, in 2026, the United States government is reaching into that same playbook, and most investors are sitting there completely blind to what is coming. That ends today. If you are not subscribed to this channel yet, that is your first financial mistake of the day, and I need you to fix it right now. Every single week, I break down the kind of economic intelligence that institutional investors pay thousands of dollars per month to access through private research desks, and I am handing it to you completely free. The investors who are positioned correctly for what is coming already know this information. The ones who are not subscribed are the ones who will be asking what happened 2 years from now. Hit subscribe. Do not wait. Your financial survival is not a hobby. Here is what is actually happening, because most people are watching the headlines and completely missing the mechanism underneath. And the mechanism is what will either make you money or destroy your purchasing power over the next decade. In 2025, the Trump administration did something that has never been done during peacetime in the United States at this scale. It took taxpayer money and injected it directly into individual private companies trading on the public stock market. We are talking about Intel, MP Materials, and Lithium Americas, just as the publicly known examples. And predictably, almost mechanically, those stock prices surged after the government money went in. That is not a coincidence. That is cause and effect. And you need to understand it as such, because the money going into those stocks was not some hedge fund's capital. It was yours. It was extracted from your taxes and deployed into equity positions that you had zero vote on and zero direct benefit from, unless you happen to already own those specific stocks. But here's where it accelerates, and why 2026 is the year you cannot afford to be asleep on this. President Trump has publicly stated his intention to establish a sovereign wealth fund, essentially a government-managed investment account funded by taxpayer dollars and potentially by money printed through the Federal Reserve. Think of Norway's government pension fund, which manages over $1 trillion in assets and owns roughly 1.5% of every publicly listed company on Earth. That is the model being discussed. The United States government becoming a direct equity investor in American and potentially global companies at a scale that dwarfs anything we have seen in peacetime American history. Additionally, on May 15th, Kevin Warsh takes over as the new Federal Reserve Chairman appointed by President Trump. Warsh has been associated with a willingness to be more accommodative on monetary policy, which in plain language means the possibility of lower interest rates and the potential for more money creation to fund these kinds of government investment initiatives. And there is currently a bill moving through Congress that would legally codify, meaning make it permanent law, the government's ability to take equity stakes in private companies. And this is not a rumor. This is the legislative architecture being built in real time. Now, you need to understand what this has meant historically, because history is the only honest analyst in the room. Let me take you to Singapore in 1980, because Singapore is the case study that the optimists are pointing to, and I want to give it a completely fair and rigorous examination, because the numbers are genuinely remarkable, and they deserve to be understood precisely. In 1980, Singapore's GDP per capita, the amount of economic output generated per person, was approximately $5,510. It was a small, resource-poor island nation with no oil, no significant natural resources, and no particular geographic advantage beyond its port. What it did have was a government that made a strategic decision. We are going to identify industries and companies that can build this economy from the ground up, and we are going to deploy state capital to scale them. The Singaporean government, through entities like Temasek Holdings and the Government of Singapore Investment Corporation, did not simply buy the stock market. They selected specific industries: shipping, aviation, telecommunications, manufacturing, financial services, and they built ownership stakes in companies within those industries with the explicit goal of creating long-term economic infrastructure, not short-term stock price support. That distinction is everything. And I will come back to it repeatedly because it is the exact line between the Singapore outcome and the Japan outcome. Now, here is what those strategic investments produced over the following 4 decades. By 2024, Singapore's GDP per capita had risen to approximately $67,760. Run that arithmetic. That is a roughly 12-fold increase in per-person economic output over approximately 44 years. Wages over that same period grew by approximately 14 times in nominal terms. Yes, when you adjust for inflation, the real wage growth compresses to approximately 3 times, but 3 times real wage growth over 4 decades in a country with no natural resources is a staggering achievement by any objective measure. And the Singapore stock market, over that same multi-decade period, delivered approximately 3 times real returns. Now, here is what the Peter Lynch investor in me needs you to understand about why Singapore worked. Because it was not magic, and it was not just the government invested in stocks. The Singaporean government invested with a specific investment thesis. These companies will build productive economic capacity that generates real revenue, real profits, real employment, and real GDP growth. They were not buying stocks to make stock prices go up. They were buying companies to make the economy go up. The stock prices follow the economic reality, not the other way around. That is the Singapore model in its purest form. And it worked because the underlying logic was sound. Capital was directed toward productive enterprise. The nation got wealthier because the businesses got more productive. That is investing as it is supposed to work. Now, let me take you to Japan, because Japan is a nightmare scenario. And I'm not going to soften this for you, because softening financial reality is how people end up broke and confused. In the late 1980s, Japan had one of the most dynamic and celebrated economies on the planet. Japanese GDP per capita in 1919-1995 was approximately $44,000, higher than most of Europe, nearly competitive with the United States. The Japanese stock market, the Nikkei 225, was on an absolute tear through the 1980s, driven by a combination of genuine industrial productivity, extraordinary corporate efficiency in automobile and electronics manufacturing, and then critically a massive wave of speculative excess funded by cheap government money and a banking system that had abandoned rational credit standards. The Nikkei peaked in December 1989 at approximately 38,900 points, then it collapsed. And here is what the Japanese government did in response to that collapse. And this is the part that should make every American investor's blood run cold right now. Rather than allowing the market to find its natural floor, rather than allowing the bad debts to be cleared and the zombie companies to fail, the Japanese government began using its central bank and state-linked institutions to buy equities, specifically broad market indexes, to artificially support stock prices. The Bank of Japan became one of the largest holders of Japanese equity ETFs on the planet. They were not buying companies because those companies had good earnings prospects. They were buying indexes because they wanted the numbers on the screen to look less terrible. And here is exactly what that produced. Japan's GDP per capita, which was $44,000 in 1995, fell to approximately $37,000 by 2024. That is a 16% decline in per-person economic output over nearly 30 years. Let that land. An entire generation of Japanese workers produced less economic value per person in 2024 than their parents did in 1995. And wages followed that same downward trajectory. Japanese real wages fell by approximately 11% between 1995 and 2025, making Japan one of the only developed nations on Earth to see actual wage declines sustained over a multi-decade period. Workers were getting paid less in real terms in 2025 than they were in 1995. And the stock market, the Nikkei 225 that the government was propping up with index purchases, it did not break its 1,989 all-time high until 2024, 35 years. A person who invested at the peak in 1,989 and held for 35 years did everything right by conventional wisdom, held through the volatility. Did not panic sell, had to wait 35 years just to get back to even before accounting for inflation. In real inflation-adjusted terms, they are still underwater. That is the cost of a government that decided its job was to prop up asset prices rather than build genuine productive capacity. The market became a ward of the state, and like most wards of the state, it stopped being able to care for itself. Now, I'm going to give you the diagnosis you actually need, because the uncomfortable truth about the United States in 2026 is that we are not clearly on the Singapore path or clearly on the Japan path. We are on both simultaneously. And that ambiguity is itself a risk that most investors are completely failing to price into their portfolios. On the Singapore side of the ledger, investments into Intel represent a genuine industrial policy argument. The United States wants to rebuild domestic semiconductor manufacturing capacity because depending on Taiwan for the chips that run every piece of modern military and civilian technology is a national security vulnerability of the first order. MP Materials represents a strategic bet on rare earth element processing, because right now China controls the overwhelming majority of the world's rare earth processing capacity, and rare earths are foundational to electric vehicles, wind turbines, advanced weapon systems, and consumer electronics. These are not irrational investments. If the thesis is we need to build this industrial capacity on American soil, regardless of whether the private market would fund it efficiently, that is Singapore logic. Government capital directed at building genuine productive infrastructure. But then look at the other side of the ledger. There were serious discussions about the government potentially stepping in to bail out Spirit Airlines. Spirit Airlines, an airline that went bankrupt because it had a deeply flawed business model, operating in a brutally competitive industry where it could not generate sustainable profits. That is not Singapore logic. That is Japan logic. Government money deployed not to build something new and productive, but to prevent the market from delivering its honest verdict on a failed business. And once you open that door, once the political system establishes that the government will step in and prop up failing companies to avoid the short-term pain of their collapse, you have created an incentive structure that is almost impossible to reverse. Every struggling company, every politically connected industry, every congressman with a major employer in their district will make the argument that their particular zombie deserves a government lifeline. That is how Japan's banking system ended up carrying decades of bad loans on its books rather than writing them down, which is a primary reason the Japanese economy stagnated for 35 years. The bad debt was never cleared. The bad businesses were never allowed to fail. The capital was never freed up to flow toward genuinely productive new enterprises. Right now, the United States is making decisions that will determine which of these two paths we actually walk down. And the honest answer is that nobody, not the Trump administration, not the Federal Reserve, not Wall Street, can tell you with certainty which way it goes. What I can tell you with certainty is that the outcome will not be neutral. There is no gentle middle path here. Either the government's capital deployment builds genuine, productive capacity and the economy expands in real terms, or it becomes a mechanism for propping up politically favored assets, and the result is stagflation, wage stagnation, and a stock market that delivers a decade or more of nothing in real terms. You need a portfolio that is honest about that binary, and that is exactly what I'm going to give you right now. Let me give you the exact mathematical framework for positioning yourself, because opinions without numbers are just noise, and I refuse to deal in noise. The first thing you need to understand is that your portfolio allocation right now needs to reflect a specific probability-weighted view on which path America takes. And that view needs to be expressed through instruments that you can actually own, that have actual liquidity, and that have actual historical track records. I'm going to walk you through 4 specific scenarios and the instruments that correspond to each one. Scenario 1. America follows the Japan path. Government props up asset prices. Real economic growth stagnates. Wages decline in real terms. The stock market delivers a decade of mediocrity punctuated by government-supported artificial force. In this scenario, your enemy is inflation eroding purchasing power, while your nominal stock portfolio goes nowhere. Your best defense is high-quality dividend-paying companies, businesses with durable competitive advantages, strong free cash flow, a demonstrated history of growing their dividends through economic cycles, and balance sheets that do not depend on cheap government-created credit to survive. An instrument like SHD, the Schwab U.S. Dividend Equity ETF, gives you diversified exposure to exactly this category of business. SHD screens for companies that have paid dividends for at least 10 consecutive years, screens for strong cash flow to debt ratios, and weights toward companies actively growing their dividend payouts. Historically, SHED has delivered a dividend yield in the 3 to 4% range, with dividend growth that has consistently beaten inflation over its operating history. In a Japan-style stagnation scenario, those cash dividends become your real return while the broader market goes sideways. You are not waiting for capital appreciation that may not come. You are collecting cash income from businesses that are generating real profits regardless of what the government's investment account is doing. Scenario 2. America follows the Singapore path. Government capital is strategically deployed into industries that genuinely build productive capacity. The economy expands in real terms. Wages grow, and the stock market reflects genuine underlying economic growth. In this scenario, the government has telegraphed its investment thesis already. Semiconductors, rare earth materials, and by strong indication from multiple sources within the administration, defense. The defense sector deserves particular attention because the logic for government investment here is almost irresistible. From a policy standpoint, geopolitical tensions are not decreasing. The United States is rebuilding its military inventory after years of drawdown, and allied nations are dramatically increasing their own defense spending, which creates export demand for American defense manufacturers on top of domestic procurement. An instrument like ITA, the iShares, U.S. Aerospace and Defense ETF, gives you diversified exposure across the major defense prime contractors and their supply chains. This is not speculation about which specific company wins a particular contract. It is a bet on the structural tailwind of increased global defense spending, which is one of the few investment theses in 2026 that has bipartisan government support and a clear, durable demand driver behind it. Scenario 3. You are genuinely uncertain, and intellectual honesty requires acknowledging that genuine uncertainty is the correct assessment right now, and you want geographic diversification as an insurance policy against American policy. Mistakes. International developed market exposure through an instrument like VXUS or similar broad international equity funds gives you ownership in economies that are not subject to the specific risks of American sovereign wealth funds. Misallocation. European and Asian companies in sectors with strong free cash flow and reasonable valuations provide a hedge against the scenario where American government intervention produces the Japanese outcome while other developed economies continue compounding normally. Emerging market exposure through something like VYU adds a higher volatility component with the potential for significant outperformance if the dollar weakens, which is a real possibility in a scenario where the Federal Reserve is pressured to cut rates and print money to fund sovereign wealth fund activity. Currency diversification through international equity exposure is not patriotism. It is mathematics. Scenario 4. You believe in American economic resilience across administrations and policy cycles, and you want straightforward exposure to the largest, most productive corporate entities in the American economy with the simplest possible instrument, SPY, which tracks the S&P 500, has delivered approximately 10.5% annualized returns over the past century, including the Great Depression, 2 world wars, the stagflation of the 1970s, the dot-com collapse, the 2008 financial crisis, and the COVID crash. If you believe that American corporate ingenuity and adaptability will continue to generate genuine economic value regardless of what any particular administration does with its investment policy, then broad S&P 500 exposure is your answer, and you should own it consistently, add to it regularly, and stop checking it every 15 minutes. The 10-year investor beats the 10-minute investor almost every single time. And Peter Lynch built Magellan Fund to 13% annualized returns over 13 years, not by predicting government policy, but by understanding businesses well enough to hold them through every short-term storm. The math of consistent compounding in genuinely productive businesses does not care about sovereign wealth funds over long enough time horizons, but you need a long enough time horizon and the psychological discipline to hold through the volatility that policy uncertainty creates. The practical portfolio construction answer, if you are asking me directly, is this. Do not make a single concentrated bet on one scenario. Build a portfolio that survives the Japan outcome while participating in the Singapore outcome. A core allocation to dividend quality equities like SHD provides your defensive floor and your income stream if growth disappoints. A tactical allocation to defense and strategic industry exposure like ITA provides your participation in the government investment thesis if it executes along Singapore lines. A geographic diversification sleeve through international developed and emerging markets provides your insurance against American policy failure. And a core broad market allocation through SPY provides your baseline participation in long-term American corporate compounding. The exact weights depend on your time horizon, your income needs, and your honest assessment of where you believe the political will of this administration is actually pointing. But the structure, defensive income, strategic growth, geographic insurance, broad market core is a framework that a rational, mathematically grounded investor should be operating from right now. Let me leave you with exactly one challenge. Because challenges are what separate the investors who build wealth from the people who just watch videos about building wealth and then do nothing. You have just absorbed more actionable intelligence about what is happening to your financial future than 90% of American investors have access to right now, and you have two choices. Choice one, you close this video, you go back to whatever you were doing, you check your portfolio in a year and wonder why it looks the way it does, and you spend another year being financially reactive instead of financially strategic. Choice two, you take the framework I just gave you, you look at your current portfolio honestly, not how you feel about it, but what the actual numbers say, and you ask yourself whether it is built for the Japan scenario, the Singapore scenario, or just blind faith that nothing will ever change. Then you make adjustments based on evidence, not emotion. The Japanese investor in 1999 who told himself the market would always come back eventually was technically correct. It did come back 35 years later. Do you have 35 years to wait? Because I do not, and neither does your retirement account. The investors who will profit from what is coming are the ones who understood the mechanism before it played out, not after. You now understand the mechanism. The only question left is whether you are going to act like it. Subscribe. Share this with every investor you know who cannot afford to be wrong about this, and start doing the work. The market does not reward ignorance, and it does not accept excuses. Neither do I.